Welcome to day 5 of your trading journey. Today we're going to unlock what price charts are really trying to tell you. By the end of this video, you'll understand trends, support and resistance, Japanese candlesticks, and chart patterns. Let's start with the first and most important concept. Trend, the market's direction. You've probably heard the phrase, the trend is your friend, and it's true. A trend is just the general direction prices are moving over time. Uptrend. The chart is going upward, forming higher highs and higher lows. In simple terms, the price keeps going up. Buyers are in control. Downtrend. The chart is sloping down, forming lower highs and lower lows. The price is dropping. Sellers are dominating. How do you identify a trend? It's all about drawing trend lines. In an uptrend, connect the bottoms, also called higher lows. If you can draw a rising line across at least 3 lows, you've got an uptrend. In a downtrend, connect the tops or lower highs. If the line points down, it shows price is falling consistently. Some traders use just 2 points to draw a trend line, but 3 gives stronger confirmation. Let's take a look at some examples. For an uptrend, we'll draw a line under the rising lows. For a downtrend, we'll draw a line over the falling highs. Once you see that slope clearly, you've identified the trend. Why does this matter? Trading with the trend increases your chances of success. It's like sailing with the wind instead of against it. You get more momentum and less resistance. When in doubt, follow the trend. Support and resistance. The price barriers you need to know. Support and resistance are key price zones where the market often pauses, reverses, or breaks through. Let's break them down. Support is the floor, the level where buyers tend to step in and push the price back up. Resistance is the ceiling, where sellers tend to show up and push the price back down. These levels are like invisible walls the price reacts to again and again. How do you find them? It's easier than it sounds. Look at the chart and spot recent highs and lows. To draw resistance, connect 2 or more tops that are around the same price level. To draw support, connect 2 or more bottoms that align horizontally. Once you connect those levels, you'll see horizontal lines forming at key turning points on the chart. The line at the bottom, that's support. The line at the top, that's resistance. These zones are crucial because price reacts to them again and again. What usually happens at support and resistance? 3 common things. Bounce. The price touches the level and reverses direction. Think of support like a trampoline. Price bounces up from it. Resistance? It's like a ceiling fan. Price hits it and gets pushed back down. Breakout. Price moves through the level with strong momentum. When that happens, you might catch a big move. Retest. After a breakout, the price may come back to that same level. Here's the trick. Support can become resistance, or resistance can flip into support. These flips are powerful signals that traders watch closely. Support and resistance are not exact prices, they're zones. They help you find entry points, targets, and stop losses. Once you start recognizing them, you'll see how the market respects these invisible walls again and again. Japanese candlesticks, stories told in a single candle. Every candle you see on a trading chart tells a story about what the market did during a specific time. Candles are usually green and red, or sometimes blue and red, depending on the platform. But no matter the color, the meaning is always the same. Each candle represents a time period, like 1 minute, 1 hour, 1 day, and so on. You can choose the time frame inside your trading platform. Let's zoom in on a single candle and explain what it's telling you. Anatomy of a candle. Open. The price at the beginning of the period. Close. The price at the end of the period. High. The highest point the price reached. Low. The lowest point the price dropped to. Now, what do the colors mean? A green candle means the price went up during that time. The closing price is higher than the opening. A red candle means the price went down. The closing price is lower than the opening. The thick middle part is called the body. It shows the open to close range. The thin lines above and below are called wicks or shadows. They show how far price moved beyond the open and close. In simple terms, the body shows direction. The wicks show how wild the market got during that candle. Candlestick patterns to know. Candlesticks form patterns, and these patterns tell us whether the price is likely to reverse, continue, or pause. Let's break them down. Hammer. Small body at the top, long wick below, found at the bottom of a downtrend. Suggests reversal up. Inverted hammer. Looks like a hammer flipped. Also bullish in downtrends. Shooting star. Small body at the bottom, long wick on top, found at the top of an uptrend. Suggests reversal down. Hanging man. Looks like a hammer but appears at the top. Bearish reversal signal. Doji. The open and close are nearly the same, shows indecision. May signal trend change. Bullish engulfing. A big green candle fully eats a red one before it. Buyers take control. Buy signal. Bearish engulfing. A big red candle engulfs a smaller green one. Sellers take control. Sell signal. Morning star. A 3-candle pattern signaling a reversal upward. Evening star. The opposite of morning star. Reversal down. 3 white soldiers. 3 strong green candles in a row. Strong bullish signal. 3 black crows. 3 strong red candles in a row. Strong bearish signal. What do these patterns really show? Candlesticks reveal emotion and momentum. They capture the battle between buyers and sellers, who's winning, who's losing, and whether the market is confident or confused. Learn to read them, and you'll start to see what other traders are thinking before they act. If you want deeper lessons on specific patterns, drop a comment. We're happy to make full training videos just on candlestick psychology and signals. Chart patterns, big picture formations. Let's talk about chart patterns. The big formations on the chart that hint at what the market might do next. These aren't just shapes. They're patterns that repeat again and again, and they help traders predict the future. The more you study them, the more you'll feel like the chart is talking to you, telling you when to buy or sell. Let's split them into 2 groups. Reversal patterns, signs the trend might change. Head and shoulders. This is one of the strongest signals that an uptrend might be ending. It looks like 3 peaks. A left shoulder, a higher peak, the head, and a right shoulder that's lower again. Draw a line connecting the 2 dips below the shoulders. That's called the neckline. When the price breaks below the neckline, it's usually followed by a strong drop. Even better, you can measure how far the drop may go. Take the distance from the top of the head to the neckline and then project it down. That gives you a rough target for the fall. Inverse head and shoulders. This is just the upside down version. It appears after a downtrend and suggests the trend may reverse upward. Double top, so very strong signal. You'll see 2 peaks at almost the same level. Think of it as price trying twice to break higher and failing. Draw a neckline under the middle valley. When price breaks that line, expect a big drop. Again, you can measure how far. From the peak to the neckline, that's your profit zone. Double bottom. Same idea, but reversed. 2 low points at the same level, showing price is likely to bounce upward. It often marks the end of a downtrend. Continuation patterns. Trend is likely to continue. Bullish flag. A long green candle, followed by a group of small candles that drift downward or sideways. It looks like a flag on a pole. After this pause, price usually continues upward, and here's the trick. The move is often the same size as the first big candle, the flagpole. Bearish flag. Same thing, but in reverse. A big red candle followed by a pause. It usually leads to more downward movement. Again, about the same size as the first drop. Rectangle. Price moves between a clear high and low, bouncing up and down. Draw horizontal lines at the top and bottom, and you've got a rectangle. When price breaks out, either up or down, the move is usually strong. And again, the move often equals the height of the rectangle. Triangles. Price gets tighter and tighter, forming a triangle shape. The breakout, when it comes, is usually fast and sharp. Cup and handle. This one looks like a teacup. A rounded dip, followed by a small pullback, the handle. After that, a powerful upward breakout. It's one of the most reliable bullish patterns. These patterns reflect crowd psychology. The hesitation before a move, the exhaustion after a big trend, the battle between buyers and sellers. And yes, they work on all time frames, 15-minute, 1 hour, daily, and across all assets. Putting it all together. Now that you've learned about trends, support and resistance, candlesticks, and patterns, here's how you combine them. Start by identifying the trend, then mark support and resistance zones. Watch for candlestick signals at those zones. Look for patterns forming in the chart. Wait for a clear confirmation and then enter your trade with a take-profit target. Don't rush. Smart traders always wait for confirmation. No guessing. Only setups with high probability. Practice time. Want to improve fast? Here's a simple practice exercise. Open a chart. Choose any asset and any time frame. Find one trend, one support or resistance zone, and one candlestick pattern. Take a screenshot. Label it trend, level, pattern. Save it. Or better yet, post it in the comments and we can give you feedback. This builds your pattern memory. The more charts you review, the faster you'll recognize real opportunities. What's next? You've mastered the basics of price action. In day 6, we'll introduce something new. Technical indicators. We'll explore moving averages, RSI, Bollinger Bands, and how they confirm the things you already know. If you feel ready to start trading for real, sign up for a regulated company below. Otherwise, keep on educating yourself. Let's move to indicators next. Day 6 is waiting.